have the bulls thrown in the towel here? I mean, is this what market capitulation looks like?
It certainly feels like you're getting towards that stage. I mean, it's worth saying that going to the start of this year, there was a lot of enthusiasm for risk assets more broadly. I think you've seen quite a pronounced sell-off over the past week or so. I wouldn't say this is the time to be buying the dip. You can come up with a positive outlook that this coronavirus impact washes through markets over the short term, and any policy response has more of a longer-term impact. But I don't think that now is necessarily the time to be sort of deploying cash back into the market.
Good morning to you, Nick. I want to just put up this. This is the GRR function on the Bloomberg. So this is the sector picture. I'm doing this over 5 days, so this is giving us a good indicator of which of the sectors have been worst hit this week and what a week it has been ever since we heard about Italy last weekend. So travel and leisure stocks now down by 19%. Basic resources and oil, of course, with falling oil prices, iron ore prices, copper prices under pressure. No surprise, I suppose, that the travel and leisure sector is at the forefront of this.
I think that's a fair observation. I mean, you look at some of those sectors, travel and leisure, basic resources, oil and gas, it's generally been the more cyclical parts of the market that have borne the brunt. The areas of the market which have proved to be more defensive are those more traditional bond proxy type parts of the market where you have a bit more long duration revenue streams, and they've generally held up okay. But having said that, those are still some pretty painful numbers.
Yeah, they're still down.
Yeah,
the best performing sector is utilities, Matt, down by 8.9%.
Yeah, so you see the defensive sectors are doing the best, and even they are down substantially. Nick, what are the safe haven assets that you think are best to buy right now? Anna and I were noting earlier that gold has actually fallen and is still down to $16.27 a troy ounce. Laura Cooper from the MLI blog was telling us that has a lot to do with margin calls. What do you see as the best bet right now if you have spare cash to put away?
Well, I mean, if you don't have government bonds at the moment, or so you have equities at the moment, you probably want to be looking for cash as the most immediate safe haven. Long-dated government bonds have fulfilled their role within a portfolio. They've proven to be pretty defensive. You have seen yields rush down, so that those assets have given you some good capital protection to sort of cushion the issues you've seen in terms of your risk assets. One interesting area is FX. I know areas such as the euro have traditionally been quite risk-on currencies, but actually what you've seen over the past week, it's traded more like the Japanese yen, having that sort of carry trades type characteristics.
Let's be brave here, Nick, shall we? And think about contrarian trades. You mentioned in your notes some tactical rebuilding of risk positions.
I mentioned that was a contrarian trade if you wanted to go down that route, and I don't think we're quite there yet.
Right.
In terms of our portfolios, we reduced some risk at the start of February, reduced some risk earlier in the week. So when you had that rally on Tuesday and Wednesday, which was quite surprising, we didn't feel quite so comfortable with that position. But actually, the market for sell-offs continued. We've still got some sort of powder to put back into the market when we get to that stage. I think you do need to see some clarity in terms of what the policy response is going to be. And also, a lot of this market move is not based around anything that's particularly tangible. There's a huge amount of uncertainty about the economic impact and what's that going to feed through in terms of earnings growth.
But where would you go to tactically rebuild? Would it be China?
I mean, if you're bullish and you think that you can get a policy response off the back of this, and the coronavirus impact is actually a bit more transitory than markets are pricing in, China would be one obvious way of doing that. The other would be to look to other cyclical markets, which have generally had more beta to economic surprises, things like Japan and Europe. But as I say, I don't think you necessarily want to be rushing in just now.